There are moments in financial history that look normal when you're in them. Incremental moves, quiet shifting of risk, routine regulatory reports. And then there are moments that, in hindsight, look like fractures in reality itself. The collapse of Silicon Valley Bank in March 2023 joins that latter class. It didn't start with a loud crash. It started with quiet imbalances, deferred risks, and the illusion that the massive machinery of modern banking was still in control. What happened at SVB was not just the failure of one bank, it was the failure of a system's assumptions, exposed under stress. And when it collapsed, the cost of the deposit insurance fund, the backstop that keeps confidence alive, was estimated to be about $20 billion, with approximately $18 billion attributed to covering uninsured deposits in the systemic response. To understand why SVB went from stability to insolvency in a matter of days, we need to look at the invisible forces that were driving its behavior for years. Silicon Valley Bank did not collapse because it was a bad bank. It collapsed because it was a bank built on contradictory incentives, staffed and marketed as a partner to the technological elite, yet holding the risks of a fixed income portfolio more typical of a long-term insurance company. In 2022, SVB's balance sheet became a contradiction, short-term deposit funding on one side and long-term interest rate-sensitive securities on the other. The bank's assets, bonds, mortgage-backed securities, government notes, looked safe on paper, yet carried enormous interest rate risk. In normal times, this mismatch might never matter. But this was not a normal time. From 2022 through early 2023, the Federal Reserve embarked on one of the most rapid sequences of interest rate hikes in decades. In response to inflation pressure, rates moved sharply higher. That might sound like background macro news, but for a bank like SVB, it was existential. As rates rose, the market value of SVB's bond portfolio plummeted. The bonds were bought in the low-rate era of 2021 and 2022. When rates climbed, those same bonds became less valuable. Unrealized losses that are not immediately visible on paper, started to accumulate. By late 2022, those unrealized losses in long-duration securities exceeded $15 billion, but here's the twist. SVB classified many of these bonds as held to maturity, meaning they didn't show up as current losses so long as the bank never sold them. This accounting assumption was an illusion of stability, masking the lurking vulnerability. This wasn't just poor foresight, it was a structural blind spot. SVB's commitment to long-term, low-yield bonds in an environment where rates were rising sharply was not offset by strong hedging strategies. Effective risk management in modern banking requires dynamic tools, swaps, duration hedging, liquidity stress tests, that anticipate rate shocks and depositor behavior. SVB's systems did not adapt. They were rooted in the belief that rates would stay low, deposits would remain sticky, and liquidity would be stable. That belief soon collided with reality. That collision began quietly with the tech sector itself. SVB's customer base was highly concentrated in startup companies, venture capital firms, and high-growth technology businesses that thrive on capital markets and investor funding when money is cheap. But as interest rates rose, venture funding dried up. Startups burned cash. Payroll obligations didn't disappear. They started drawing down deposits to meet operating needs. The deposits that once made SVB seem flush began to shrink. That shrinking deposit base was the first crack in the bank's foundation. This is where control starts to slip. A bank thrives on confidence and liquidity. When depositors believe their money is safe, funds stay put. When belief wavers, they move their money. On March 8, 2023, SVB announced that it had sold over $21 billion worth of securities at a loss and intended to raise additional capital to shore up its balance sheet. That announcement, meant to signal strength through transparency, had the opposite effect. It told the market that the bank was weaker than expected. Within hours, whispers turned into panic. Tech companies and venture-backed firms began withdrawing deposits en masse. One investor's tweet was enough to signal to others that the bank might not survive. Within 24 hours, SVB faced an unprecedented modern bank run. Depositors withdrew tens of billions of dollars, far beyond what the bank had in cash reserves. This was a run not orchestrated by mobs outside a bank branch, but through keyboards and phones. It was the first bank run amplified by digital networks, where fear propagates at the speed of light. What might have taken weeks or months in the past happened in a few hours. Within that span, SVB's cash position turned negative as the bank struggled to meet withdrawal demands. In that moment, the fragile assumptions underpinning its risk model shattered. Here's what control looked like before the collapse. SVB believed its deposits were stable, its securities were safe, and its liquidity needs were manageable. The reality was starkly different. Time and confidence were no longer on the bank's side. Banks operate by a fundamental principle. You borrow short and lend long. You rely on deposits to fund loans and investments that are less liquid. As long as depositors don't panic, this system works. But the moment depositors lose confidence and start drawing cash, especially if those deposits are uninsured, The system reveals its Achilles heel, and SVB didn't just have uninsured deposits, it had an overwhelming majority of them. About 89% of the bank's $172 billion in deposit liabilities were uninsured, meaning they exceeded the FDIC's $250,000 insurance threshold. That meant, for most of SVB's clients, their entire account balances were at risk if the bank failed, a psychological and financial accelerator of panic. Palm-greasing tension turned into a sprint once the news broke. By March 10th, the California Department of Financial Protection and Innovation stepped in and seized SVB, appointing the Federal Deposit Insurance Corporation as receiver. Regulators recognized that an uncontrolled collapse could threaten confidence across the banking system, especially among regional banks with similar structures. To prevent contagion, regulators invoked emergency powers and took the extraordinary step of guaranteeing all deposits, insured and uninsured, despite the FDIC WS standard insurance limits. This was not normal protocol. It was a tactical decision to preserve systemic stability. The cost of this emergency response fell primarily on the FDIC's Deposit Insurance Fund, DIF, which is funded by insurance premiums from banks and serves as the backstop for bank failures. Regulators estimated that covering SVB's collapse would require something in the ballpark of $20 billion, including about $18 billion, to cover uninsured deposits under systemic risk determinations. That figure was historically significant, one of the largest hits in the fund's history, and would ripple into future insurance assessments and bank costs across the system. In the space of a weekend, what looked like control, a bank confident in its balance sheet, a regulator confident in oversight, and a financial system confident in its resilience, gave way to failure driven by mismatched incentives, ignored risks, and a breakdown of confidence. To truly grasp the collapse of Silicon Valley Bank, you must understand not just what happened, but why the mechanisms that were supposed to control risk instead amplified failure. SVB didn't collapse because of a single headline or a single decision. It collapsed because the foundational assumptions of modern banking, confidence, liquidity, and risk dispersion, were quietly abandoned long before March 10th, 2023. And when those assumptions failed, the entire risk structure collapsed with them. Silicon Valley Bank's business model was, on the surface, deceptively simple. It accepted deposits from businesses and startups, particularly in the tech world, and reinvested those funds into securities, loans, and long-term bonds. Much of that investment was in U.S. government bonds and mortgage-backed securities, traditionally considered safe. But safety in finance is relative to interest rate environments, and the environment changed dramatically. When the Federal Reserve began its aggressive interest rate tightening cycle in 2022 to fight inflation, the value of existing bonds dropped. A bond that yields 2% in a 5% environment is worth far less than its face value. SVB had tens of billions of dollars in long-term securities. On paper, these were held-to-maturity assets, meaning the bank did not need to mark them at market value until they were sold. But market forces do not wait politely when crisis strikes. The effect of rising rates on SVB's balance sheet was like cracking ice beneath your feet while you standing still. You don't feel the danger until the surface gives way. Unrealized losses of more than $15 billion started accumulating in SVB's securities portfolio. That was money the bank had lost on paper, but still held physically. If the bank could ride out the storm, pay its depositors, and never sell those bonds, it could stay afloat. But once the depositors began to doubt, that strategy ceased to exist in practice. And then came the run, not the slow, queue-forming runs of old, but a digital sprint of confidence collapsing. On March 8th, 2023, SVB announced a massive sale of $21 billion in securities at a significant loss and an attempted capital raise of about $2.25 billion to shore up its balance sheet. It was the bank's attempt to prove strength. Instead, it was interpreted as a confession of weakness. In banking, perception is reality. Words matter, and those words triggered panic. Within hours, depositors were pulling out cash in massive volumes. According to regulatory filings, as much as $42 billion was withdrawn in a single day. The bank's cash reserves dwindled to almost nothing. Where ordinary banking operations might unfold over weeks or months, this unfolded in hours. A real-time bank run amplified by instant communication, tweets, fund managers alerting their networks, and venture capital firms telling startups to withdraw funds while they still could. This wasn't just a bank run, it was a confidence implosion. Banks operate because people believe they will be solvent tomorrow. When that belief collapses, the system collapses with it. Depositors are not irrational for pulling their money. They are rational actors in a fragile system. When the perceived probability of failure spikes from 1% to 99% in a few hours, everyone tries to get out at once. That dynamic is exactly what regulators feared but didn't fully anticipate. But why did this panic spread beyond just SVB? Why did other banks feel the shockwaves? This is where the critical idea of contagion, systemic risk, comes in. Institutions are linked through perception and real economic ties. Signature Bank and First Republic Bank, both with vulnerabilities like high blocks of uninsured deposits, experienced rapid deposit withdrawals and market value declines immediately after SVB's collapse. Trading in the holding companies' shares of these banks was temporarily halted as markets reacted. Bank runs do not respect individual balance sheets. They prey on vulnerability. A bank with 50% uninsured deposits is more stable in a crisis than one with 88% uninsured deposits, because the latter has more to lose if confidence wanes. SVB had roughly 88% uninsured deposits, meaning most of its customers had amounts exceeding the FDIC's $250,000 insurance limit, making them far likelier to pull funds quickly at the first sign of trouble. As deposits drained away, SVB faced a liquidity crisis. The securities that were intended to be safe could not be sold without crystallizing massive losses. To meet withdrawals, SVB had to sell those long-term bonds at a loss, turning unrealized losses into real ones. That move was a death knell for the bank's financial statements. Once a bank's capital erodes below regulatory minimums, insolvency is imminent. Just like that, what was once a solvent institution became an insolvent crisis in motion. At that point, regulatory oversight committees had no choice but to intervene. The California Department of Financial Protection and Innovation seized the bank and appointed the FDIC as receiver on March 10, 2023, a matter of days after the crisis began. This was not a gradual wind-down. It was a regulatory emergency action to prevent broader systemic collapse. Now we arrive at the transfer phase, the part of the framework where the failure of control and the loss of confidence ripples outward, forcing losses onto broader shoulders. The FDIC took extraordinary steps by invoking a systemic risk exception, something rarely used, to guarantee all deposits, including uninsured ones, under a joint announcement with the Treasury and Federal Reserve. Regulators wanted to ensure that those who lost faith in one institution did not use similar fears to attack another. There was a strategic logic to this move. If uninsured depositors believed they would lose their money, they would be more likely to flee other banks with similar profiles, accelerating a crisis. To prevent that domino effect, a full-blown financial panic, regulators acted decisively. It was a bailout not for shareholders or executives, but for depositors and, more importantly, for confidence in the entire banking system. The cost of this intervention was steep. The FDIC estimated that covering the losses related to SVB's failure, particularly for uninsured deposits, would subtract about $20 billion from its deposit insurance fund, with approximately $19.2 billion tied specifically to those systemic risk protections. This figure was not the bank's loss in isolation. It was the loss socialized across the financial safety net to keep the system functioning. But calling it a bailout is misleading. No taxpayer dollars were supposed to be directly used. Instead, the losses would be recouped through special assessments levied on member banks over time. The idea was to spread the burden across the industry and maintain stability. This is the transfer, a shift from a failing node to the broader network, a translation of individual collapse into collective insurance. The contagion threat did not end with SVB. Markets watched closely. Signature Bank was closed shortly after, and First Republic Bank experienced heavy deposit outflows. The stress on smaller and regional banks showed that the underlying vulnerabilities, uninsured deposit reliance, interest rate exposure, and liquidity mismatches, were not unique to SVB. The crisis had revealed an inherent brittleness in how mid-sized banks were structured and regulated. Yet regulators insisted that this did not signal a broad systemic collapse like 2008. That was part of controlling the narrative, to prevent a self-fulfilling spiral of fear. In assuring the public that deposits were safe and that regulatory frameworks were responding, authorities were trying to restore confidence, not just balance sheets. The banking system, like any complex social system, is held up by belief and expectation as much as by actual capital and liquidity. Once the first cracks appeared in Silicon Valley Bank's financial structure, the belief that modern banking had control over risk began to unravel. For years, regulators, executives, and investors told themselves that the frameworks developed after the 2008 financial crisis, Basel III, stress testing, capital requirements, had shackled volatility permanently. Yet the failure of SVB exposed a profound weakness. Those controls could mask risk on paper, but they could not contain it once confidence was gone. SVB's downfall did not occur in isolation. It was the product of a timing mismatch between assets and liabilities, where long-term securities were funded by short-term and often uninsured deposits. Fundamentally, SVB's bond portfolio was heavily invested in long-term fixed-rate government securities and mortgage-backed instruments. At low interest rates, these assets were profitable. But as the Federal Reserve raised rates aggressively in 2022 and 2023, The value of those held to maturity bonds declined sharply, generating massive unrealized losses. These losses were dormant until the bank needed liquidity, at which point they became real. At the same time, regulatory reporting did not immediately reflect the risk building under the surface. Under the accounting standards then in place, unrealized losses on long-term securities did not erode capital unless sold, creating the illusion of health, even as the bank's risk exposure grew. SVB ES audit frameworks and lack of dynamic hedging strategies meant there were no robust safety cushions for a scenario where interest rates would rise sharply and depositors would flee. This was a dangerous blind spot, one that internal risk teams failed to correct. The second piece of the control failure was the composition of SVB's deposits. Unlike a diversified retail bank with millions of account holders splitting deposits across small sums, SVB's deposit base was highly concentrated and largely uninsured. In fact, roughly 88% of SVB's deposits exceeded the FDIC's $250,000 insurance limit. This concentration meant that nearly all of SVB AS customers had more at stake than simple peace of mind. They had substantial financial exposure. That vulnerability was a key factor in the rapid acceleration of the bank run. Depositors were not just casual savers. They were companies that drew cash to meet payrolls that were becoming harder to meet as venture funding dried up in a tightening economy. When SVB announced it would sell securities at a loss and raise capital, actions intended to shore up the bank's balance sheet, depositors interpreted it as evidence that the bank's foundational assumptions were wrong. They did not think twice. Funds were pulled out in enormous quantities in a matter of hours. This is where control gave way to failure through perception. Banking is built on confidence, the belief that your money is safe there tomorrow. But confidence is not a tangible asset. It is a psychological contract upheld by collective behavior. Once that contract fractures, the liquidity framework collapses. Depositors moved faster than machines could react. Within 24 hours, tens of billions of dollars were pulled from SVB, forcing the bank to sell assets at a loss to meet immediate obligations. The sale of long-term securities, once thought to be stable investments, crystallized deep losses and drained the bank's capital almost instantly. What occurs next is the heart of the systemic failure mechanism. When a single institution collapses, the panic does not respect institutional boundaries. It moves through the system like a shockwave. Signature Bank, another regional institution with a similarly high proportion of uninsured deposits, experienced massive withdrawals immediately after SVB's collapse. Regulators closed it within days. Even relatively stable banks began to see elevated withdrawal activity as depositors re-evaluated risk across the board. This contagion effect is the reason why financial stability is about networks, not individual balance sheets. It is important to understand why the usual regulatory safety nets were ineffective in this environment. Under the traditional model, the FDIC insures deposits up to $250,000 per account and relies on capital and liquidity requirements to prevent runs. But when most of a bank's deposit base is uninsured and concentrated among large institutional holders, the insulation that insurance provides is drastically weakened. The rapid withdrawal sequence of SVB demonstrated that traditional insurance limits are not robust when fear meets concentration. At this point, regulators were forced into an extraordinary decision. On March 12, 2023, just days after SVB's failure, the FDIC, the Treasury, and the Federal Reserve announced that all depositors, insured and uninsured, would be protected under the systemic risk exception. This was a move designed not to protect the shareholders or executives of SVB, but to prevent a cascading collapse of confidence across the banking sector. Tellingly, spectators in markets interpreted this as the moment when losses were socialized across the system. The scale of that transfer was massive. Estimates from regulator reports and audits indicate that the FDIC Deposit Insurance Fund would incur approximately $16.3 billion in costs related to SVB's collapse, with most of that covering uninsured deposits under the systemic risk exception. That requires subsequent special assessments on other banks to replenish the fund so that stability and depositor confidence can be maintained in future crises. In effect, losses that were once confined to one bank were spread across the broader financial industry, forcing institutions to carry a share of the systemic cost. But even this transfer masked a deeper truth. Confidence in the risk controls themselves had been damaged. The assumption that mid-sized, specialized banks could function outside the scrutiny reserved for larger, too-big-to-fail institutions was shown to be flawed. SVB's concentration risks, mismatches in maturity, and underhedged portfolios were not anomalies. They were symptoms of a wider regulatory environment that had not fully adapted to post-pandemic conditions. The rapid contagion risk demonstrated that financial networks are only as strong as their weakest link, and that gap can turn into a systemic crack in moments. In essence, what was transferred during this crisis was not just financial loss, it was confidence capital. Confidence in risk models, confidence in insurance limits, confidence in regulatory oversight, confidence in the stability of the banking system itself. When SVB collapsed, it revealed that many of these pillars were weaker than advertised, eroding trust at a structural level. Recovery, therefore, required not just liquidity injections and guarantees, but a reestablishment of belief that the system could still function under stress. The implications of this moment are far-reaching. Risk management frameworks, capital requirements, and liquidity tests will be debated, reformed, and perhaps rewritten in the aftermath. But more fundamentally, the SVB episode underscores the fragile interplay between perception and solvency. No matter how sophisticated the models or how deep the capital, systems dependent on belief can topple when trust evaporates. That is the lesson carried forward, and it is a lesson paid for not just in dollars, but in the collective psyche of the financial world. When Silicon Valley Bank collapsed in March 2023, it didn't want to just take one institution down with it. It shoved a spotlight on the entire architecture of modern banking risk control. SVB's failure was dramatic because it was sudden, but the structure of the failure was systematic. It exposed how fragile the supposed monotone controls really were, and how quickly they could be overwhelmed when confidence broke. And once regulators stepped in, losses didn't simply vanish. They were transferred, socialized, and reallocated across the financial system in ways that continue to ripple today. The moment when SVB ES collapse went from an isolated incident to a systemic warning shot was when regulators invoked the systemic risk exception under the Federal Deposit Insurance Act. Standard FDIC insurance covers depositors up to $250,000, a protective baseline designed to prevent ordinary bank runs. But SVB's deposit base was highly concentrated among corporate and institutional accounts, and roughly 90% of those deposits were uninsured, well above the traditional insurance cap. When confidence collapsed and withdrawals cascaded, regulators faced a choice: let uninsured depositors suffer losses, risking panic across other institutions, or intervene to preserve stability. The decision to guarantee all deposits, both insured and uninsured, was not normal protocol. It was a systemic lifeline. It meant the FDIC's backstop, the Deposit Insurance Fund, would be tapped at unprecedented levels to prevent the crisis from widening. Estimates from government oversight reports indicate that the total cost to the Deposit Insurance Fund from SVB's failure was originally projected at around $20 billion, with similar costs following the near-simultaneous failure of Signature Bank. In context, these represent one of the largest hits to the FDIC's reserve in decades. What does this transfer of loss mean? It wasn't a direct bailout funded out of thin air. Regulators stressed that no taxpayer dollars would be used, that the fund itself would bear the initial burden. But the finance industry is a tightly connected network. To replenish the Deposit Insurance Fund, special assessments are levied on member banks, meaning financial institutions generally will shoulder the cost over time. That, in turn, affects the incentives and risk models of banks for years to come. This is the transfer phase in action. Control failed, confidence evaporated, and the loss shifted from one institution to the broader network. Customers were protected, yes, but the underlying structural assumptions about risk when deposit insurance were fundamentally challenged. The bigger implication of this transfer is not merely financial, it's psychological. By choosing to protect all depositors, regulators effectively rewrote the rules of what bank safety now means. Insured deposit thresholds were no longer the final measure of security. Market participants began to speculate that a soft deposit insurance might be implicit for major institutions, that the FDIC, the Fed, and the Treasury would act preemptively if confidence eroded sharply enough. This kind of backdoor guarantee changes depositor behavior in subtle but powerful ways. But even that wasn't the end of the story. In the immediate wake of SVB's collapse, other banks felt the shockwaves. Signature Bank was shuttered by regulators 2 days later amid similar deposit outflows, proving contagion was not theoretical. It was real. Mid-sized and regional banks with high uninsured deposit levels felt pressure as depositors reevaluated their risk tolerance. Markets reacted not just to one failure, but to the possibility of others. Because once confidence falters, contagion can follow without warning. Part of the reason this contagion risk was so potent lies in the interconnectedness of financial networks. A bank like SVB might have been specialized, but its clients, tech firms, startups, venture capital accounts, were embedded in the wider economy. When those clients faced liquidity stress, they drew down accounts, then reduced spending, then pulled funding from other institutions. This micro-decision cascade becomes macro-reality in minutes. At the same time, regulators were aware that allowing uninsured depositors to take significant losses could have triggered a broader flight from risk across the banking system, a confidence spiral not unlike what was seen in 2008. So the controversial decision to cover all deposits was as much about psychology and narrative control as it was about dollars and cents. It was a decision meant to signal that the system, though shaken, was still capable of protecting participants and containing panic. Yet there was an irony in that choice. By stepping in so forcefully, regulators arguably reinforced the idea that the status quo would always be defended, making some depositors less wary of risk and reinforcing moral hazard. The notion that safety nets will catch failures regardless of underlying risk. This can encourage riskier behavior over time, effectively transferring part of the bank's loss into the incentive structures of the entire financial environment. SVB's collapse also triggered renewed scrutiny of risk management practices across the industry. Government accountability offices, central bank examiners, and congressional committees began to question whether existing oversight frameworks were adequate for a rapidly changing financial landscape where digital communication can fuel panic in minutes. Reports pointed out that SVB's risk management was not commensurate with its scale and complexity, particularly in terms of liquidity risk and uninsured deposit reliance. In hearings and regulatory assessments, the failure of SVB was described by some officials as a textbook case of mismanagement, highlighting how risk controls had been ignored or inadequately enforced even after earlier warnings were issued. According to testimony from Federal Reserve leadership, banks like SVB did not effectively respond to supervisory concerns about interest rate and liquidity risk, leaving them exposed when market conditions changed. Beyond immediate regulatory reactions, the SVB collapse ushered in broader debates about banking policy. Should the insurance cap remain at $250,000? Should there be different frameworks for non-retail banking institutions? Discussions in Congress and among regulators began to explore whether the deposit insurance system needed reform to account for modern depositor behavior and risk concentration, especially in an age where digital communication can mobilize bank runs with unprecedented speed. Legislative proposals to raise limits on certain types of accounts were considered, a shift that would reflect a new understanding of systemic risk and depositor psychology. For the ordinary depositor or corporate cash manager, the story of SVB's collapse becomes a lesson in fragility and adaptation. It shows that systems built for stability can be destabilized not only by bad luck, but by misaligned incentive structures, rapid changes in economic conditions, and modern communication channels that amplify fear. And when those systems fail, the losses are not isolated. They are transferred outward, reshaping expectations, policies, and individual behavior. In this sense, SVB's collapse was not just a bank failure, it was a structural shock, an exposure of the limits of traditional banking models, and a test of how much confidence a financial system can absorb before the illusion of control becomes a liability. Confidence, once lost, cannot be restored just by words or guarantees. It must be rebuilt through credible systems, transparent risk frameworks, and meaningful incentives that align safety with responsibility. This moment will be studied for years, not just for the loss to the deposit insurance fund, but for how the banking ecosystem responded when confidence cracked and control slipped. The $20 billion figure is not just a cost. It is a marker of a systemic transfer, from localized failure to distributed responsibility, from isolated risk to collective memory, and from complacency to lingering skepticism about the durability of financial controls. And in that transition lies the future of how modern banking must adapt, or risk failing in the next moment of stress.